Hi everybody, Q here from Hyperstocks. Thank you so much for checking in. In this video, we're going to go over SPY, which is the S&P 500 ETF, and we're also going to cover some other notable names on the market such as Tesla, Apple, AMD, Nvidia, Meta, and last but not least, Amazon. We're going to go over these stocks, their charts, and their price targets, but before we do so, we have to talk about some things that happened last week and some things that are happening this week that could potentially force markets to pull back even more or push them back to new highs. So let's go ahead and dive right in with the first and the most important thing that happened last week, which was the release of the US retail sales data. US retail sales data edged up by slight 0.1% for the month of May, surprising analysts, but still coming right about flat month over month. The biggest gain came from sporting goods, hobby, music instruments, and books. This is likely because we're going into the summer. And the biggest decline came from gasoline stations, which is likely because school is out. So with that being said, if you are a retail investor, and I'm not saying that you are one of the retail investors, I'm saying if you're invested into retail stocks, so such as Macy's, your Targets, your Walmarts, this is a number you want to pay attention to. You have to remember that retail and the consumer are at the forefront of our economy. So what they're doing and how they're using their capital is going to reflect directly in company earnings in the coming quarters. Now that wraps up last week. It actually wasn't an eventful week. We had a shortened holiday week, so we're going to jump right into this week's key economic reports, which is going to start off the week with a conversation from Christopher Waller, President Austin Goolsbee, and finally President Mary Daly. These are all Fed members. The most important one here is going to be Austin Goolsbee because he has historically been known to drive markets slower. Every time he's spoken in the last few weeks, markets have gotten anxious and pulled back. And so starting off the week with him is going to be a little choppy. We might see markets reacting poorly. So keep that in mind as you head into the first day of the week. Now, the second day of the week, we have the Consumer Confidence Report. The Consumer Confidence Report, as you can see, has gone up month over month from 97.5 to about 102. This month, it's expected to come in slightly lower at 100, but still a pretty good reading considering what's going on with the economic hardships in the US. However, if that number slips below 100 and starts falling back down, it may indicate some weakness in consumer optimism. Next up on the agenda this week is going to be this GDP second revision. Now, this is a key number to pay attention to, you guys, because GDP has actually come down in the last 3 quarters, and it's actually at its lowest reading in multiple quarters. Something you have to remember is that we were all in fear of a recession happening last year, but looking at the GDP growth and the numbers, it's projected that we're starting to decline. Now, a recession is defined as 2 back-to-back negative GDP quarters. We haven't gotten that here yet in the last few quarters, but going into 2025, if consumer confidence begins to slip, then we may see GDP actually also come down into the negative. And if we get 2 back-to-back negative GDPs, then we would officially enter a recession. Next up on the calendar this week is also the PCE report, and this is going to be the most important report, and it will come out on Friday before market open. So we can expect a large upside or downside move to happen at market open on Friday. The PCE report is the Federal Reserve's preferred inflation index. Now, last week or 2 weeks ago, we had the consumer price index, which is another inflation report, and that showed that inflation actually came down from 3.4 to 3.3% month over month, thanks to falling gas prices. Now, the PCE report measures the same thing, but on a different scale, and that currently reflects inflation at 2.7%. Remember that the Federal Reserve's target is 2%. So the closer we are getting to that number, the closer we could be to finally getting some interest rate cuts, which is ultimately what markets are looking for. So now that we've covered the economic front, let's go ahead and jump into our charts, and we're going to start off with SPY because it gives us an idea of what the overall market is doing. Before we jump into the micro chart though, let's go ahead and talk about it on the macro chart. So we're going to focus on the daily chart where we can see that For the first time in a while, we saw a little pullback, and that really scared investors. SPY closed below its overnight uptrend for the first time in more than 20 days. The last time it did so, it recovered very quickly, but this time around, we're expecting the pullback to last a little bit longer. On the daily chart, if you are watching, you have to pay attention to the 10 and 20-day moving averages. If you notice, when we look back on this rally ever since it popped up in the beginning of May, SPY has been using that 10, which is the blue line, and the 20-day moving averages as support on its way up. And so if it does break below those levels, then we may see more weakness and it could lead it back down towards its 50-day moving average. Now keep in mind, that is a very aggressive downside target, so it would be unlikely that we see that this week, but you never know what happens. You always want to stay prepared. And in the case that you are not a moving average trader, so if you don't pay attention to moving averages, here are some levels to focus on the shorter term charts. Now, we believe that the pullback is going to take us towards 528 to 531. That would be our pullback target, and which we would consider entering a bullish position on. If the market pulls back further than that, then the next downside target is going to be between 518 and 522, which is where that 50-day moving average is currently trading. So when you are looking at a chart, especially the daily chart, the first and last thing you want to check on every single day is where did that daily candle open in relation to these moving averages. If it opens or closes below them, then that means they lost that support and we can begin filling the downside towards the next moving average or towards the next price level support. And that's as far as SPY goes. Now remember, SPY is pretty much the whole market, and so if SPY is pulling back, then the rest of the market or big parts of the market are going to pull back too. Now, the pullback last week was induced by a strong pullback from Apple and Nvidia. We can see that Apple lost that 220 mark and it started giving up that big rally that we saw last week, closing below its 10-day moving average on Friday. It did so here and then quickly got bought back up. We do not expect that to happen again this week. We are leaning a little more bearish on Apple, considering it's gotten 3 red candles in a row. And Friday's candle was accompanied with very strong selling, stronger selling than these 2 buy-up days, which is something you have to account for. Now, with that being said, let's focus on some shorter term levels for Apple. When we look it up here, we can see that Apple is currently, yes, in a bullish position, but it is very close to losing that bullish position if it breaks below 205. The rally between 193 and 205 was merely vertical, which is why it's so easy for the stock to fill it back down. It's always easier for a stock to move back and fill that gap down when the rally is vertical, because it didn't build up enough volume and buyers in order for it to really last that long at those highs. And so if Apple begins to break below 205, we actually can expect it to fall below 200 very quickly. So keep that in mind when you're watching Apple. But if it does come back around somehow, some way, there's a catalyst that moves it up, our resistance points are 214.35 and the ultimate breakout is 220.20, which is its all-time highs. The next stock on our watch list is also a stock that fell to end the week, surprising everyone and giving up more than $200 billion in its market cap, which is larger than the size of Disney. So this is a major drawdown for Nvidia. This is the biggest drawdown it's gotten in months. And so without being said, investors are nervous coming into this week. Keep in mind that everyone has been waiting for Nvidia to finally pull back. So with that being said, early on in the week, we might see an attempt to buy up the stock, but depending on the volume and momentum of that event, it may not last. So if buyers aren't strong enough to buy it up at these highs, then Nvidia may be due for a bigger pullback, or it may be due for a mere consolidation period. It doesn't necessarily mean that Nvidia is going to sell off back towards the 90s. It just simply means that Nvidia may enter a period in which it moves sideways for a while and then eventually gets enough strength to push back up or sells off as sellers continue selling off their positions. Now, if you are looking at Nvidia on the shorter term charts, here are some levels to focus on. Nvidia bounced right at our 124.35 support last week. You can see that it closed just above that point. So coming into this week, That's our main support and focus. If it breaks below, we have another support at 117 and we would still be bullish on the stock. Now, if it breaks below 117, that's when things can get a little shaky. And the reason why I say that is because you can see that between June 5th until June 12th, which is about a week, Nvidia spent consolidating between 117 and 124. So that means there was a lot of buyers that were getting pent up over here. And so if these guys see Nvidia move back into that range, they may get a little nervous and begin unloading their position. And if it breaks below 117, that's when it can get in trouble. And of course, 107 is the bearish pivot, which was this reversal right here. The next stock on our watches is going to be Tesla. Now, Tesla made a very key move in the last couple weeks, and that was getting back above its 100-day moving average. So if you're not familiar with our videos, we use the 10, 20, 50, 100, and 200-day moving averages. We don't use them religiously, but we always like to have them on our chart because they're a pretty good gauge on if the stock is currently leaning more bullish than bearish. You can see that when Tesla broke below its 100-day moving average a few months ago, it continued to sell off for months. And so now that it's back above, buyers may finally have a chance to push it up. Here are some levels that we're focused on. Tesla is not yet in a bullish zone. It's going to need to break above 191.60 in order for it to enter that bullish range. Above that, our price target is going to be 198, and our second price target is 206. Now, keep in mind, these are very aggressive price targets, and we will update them in the coming weeks. So make sure you're checking back into these videos. To the downside, if Tesla fails to hold that 100-day moving average, then Tesla has a support at 166, and below that point, it can sharply move lower towards the next two supports. The next stock on our watch list has been a very big disappointment for semiconductor and artificial intelligence investors in the recent months. Yes, AMD is still significantly above their lows. However, the stock has really struggled in recent weeks, especially compared to its peers like Nvidia, who's doing extremely well. AMD has been trading below its 100-day moving average, consistently getting rejected at it. And even when it tried to rally last week, you can see that it got sold back down and closed mostly flat. So here are some levels to focus on for AMD if you are looking. Like Tesla, AMD is currently not in a bullish or a bearish trend. It's currently just flat, and buyers and sellers are fighting to get their way. If you are a buyer, you need AMD to make a move back above 174.55 in order for it to see these two price targets, and to the downside, these are the support levels that we have in place. The next stock on our watch list is going to be Meta, which was doing a great job holding its 10-day moving average up until Thursday and Friday, when it broke below and moved towards its 20-day moving average, which is a great example of why we were mentioning on SPY you need to pay attention to where the daily candle opens and closes in relation to that 10-day moving average. You can see that after Meta closed below its 10-day moving average, the next day it sold off to its 20-day moving average, which is something that could easily happen on other charts, and this is a prime example. If you are on Meta's shorter term charts, we can see that Meta is currently fighting a bullish trend. It's fighting a bullish range, but it's getting very close to breaking below it and moving back in this consolidation range. Like we just mentioned on the other names, this was a long multi-week consolidation period for Meta between May 1st and about June 1st. So if buyers see Meta move back into this range, they're going to give up hope and they're going to sharply sell it back down. So 490 and 468 are extremely important supports, and 448 is the bearish pivot in which we expect the sell-off to intensify. Now, this is a very aggressive downside target, so keep in mind that you want to check back in for our updated levels. If you are bullish on Meta, you need to break out above 516.88 for a move towards the 531 to 532 level. Last but not least, which is Amazon. Amazon actually, unlike the rest of the market, had a phenomenal day on Friday. You can see that volume kicked in. It closed strongly above its 10 and 20-day moving averages, and also above this resistance in which it has gotten rejected at before. So if you are looking at Amazon, here are some levels to focus on. We're going to move our support down towards 181.20 because that was the reversal point. So now that becomes our new support for Amazon. And then we also have another new resistance, which is going to be the 191.70. So we're going to remove this resistance because you can see it closed above it. And the only next resistance we have in place now is going to be 191.70, which is its all-time highs. We can argue that there might be a support here at 185.85, so we're going to put a slight support at 185.85 in which you can use if you enter a bullish position and you want to ride it towards 191.70. Now, just like Apple, Amazon's move between 174 and 181 is extremely vertical. And what did we just say about vertical moves? They're easy to get filled back down. And so if Amazon reverses and breaks below 181.20, we expect a sharp move back towards 174 in the coming weeks. This is an aggressive price target, so make sure you subscribe and check back into our videos. But that wraps up our video update for the week, you guys. I hope you found it helpful. Best of luck on the week ahead.